First, welcome to our deep dive on financial advisor red flags. In this video, we will clarify how to spot common pitfalls when choosing professional guidance. By the end, you will know how to evaluate outreach, credentials, fees, fiduciary obligations, and post-rollover audits. Next, here is our roadmap. We will begin with why vigilance matters. Then we will examine the red flags around unsolicited outreach, check which credentials actually mean something, and break down fees. After that, we will talk about fiduciary duty, what to do after a rollover, how to vet an advisor, and we will reinforce learning with quick quizzes. Finally, we will end with key takeaways and an important disclaimer. To begin, financial health underpins many shared life goals. Because small percentage costs compound into large dollar amounts, even minor misalignments can have outsized effects. Therefore, understanding advisor incentives and obligations is essential to protect your long-term outcomes. Now, be wary of advisors who initiate contact through cold calls, unsolicited messages, or social media outreach. Professionals who put clients first usually rely on referrals and measured introductions. Aggressive pitches often imply a sales quota or commission goal. If an initial contact is uncomfortable or pressured, it is reasonable to decline and continue your search. Moving on, prioritize recognized credentials like the Certified Financial Planner and Chartered Financial Consultant. These designations typically require comprehensive training and adherence to professional standards. Independently verify status and any disclosures using official sources such as the CFP Board Directory, FINRA BrokerCheck, and the SEC Investment Advisor Public Disclosure website. Meanwhile, approach narrowly focused or niche designations with caution, because their scope and fiduciary requirements may not match those of comprehensive planners. Always ask what fiduciary standard applies and under which circumstances. Furthermore, fee opacity is a critical warning sign. Demand an unambiguous answer to whether the advisor is fee-only and acts as a fiduciary at all times. Percentage-based assets under management fees appear small, but can compound into substantial opportunity costs. The illustrative pie chart shows that a 1% fee can absorb a meaningful fraction of long-term growth. Consider structures that align incentives and reduce conflicts, such as flat or advice-only fees, and require clear written disclosure of all costs. Additionally, consider these simplified, hypothetical calculations. With no fee at a 7% gross return, a $50,000 starting balance and $10,000 annual contributions grow to roughly $1,325,000 after 30 years. With a 1% AUM fee, effectively reducing the net return to about 6%, the ending value falls to approximately $1,078,000, which is about $247,000 less. Own. A 0.5% fee yields around $1,185,000. While a 1.5% fee yields roughly $971,000. These are illustrative figures, not guarantees, and actual outcomes will vary. Next, verify fiduciary duty in writing and confirm it applies at all times, not only in limited contexts. Then, ask precisely how the advisor is compensated and which conflicts may exist. If the compensation model involves AUM percentages or commissions, quantify the lifetime cost and consider whether the incentives align with your interests. If an advisor cannot provide clarity or refuses to commit to a comprehensive fiduciary standard, it is reasonable to disengage. Meanwhile, after any significant asset rollover, conduct a prompt audit. Within the first 1 to 2 months, confirm the investment policy, holdings, and expense ratios. Compare performance, risk level, and diversification to appropriate benchmarks and to your prior plan. Request a complete fee schedule and identify any restrictive features, such as surrender charges or proprietary product requirements. If the new setup is not aligned with your plan, evaluate alternatives, including transfers where appropriate. Subsequently, follow a structured vetting process. First, clarify your needs and budget. Then, rely on referrals instead of unsolicited outreach. Verify credentials and disclosures through official registries. Require a written fiduciary commitment and obtain a concise fee summary. Model the lifetime cost of different fee structures. Review a sample plan and ensure the investment policy is understandable. Finally, assess conflicts. Avoid unnecessary complexity and pause if there is any pressure or confusion. Comparatively, a fee-only fiduciary model is designed to align with client interests through transparent fees and minimized conflicts. It often supports broader planning that integrates investments, risk management, and tax awareness. In contrast, commission or asset-gathering models can tie compensation to sales or asset levels, potentially introducing opacity and misaligned incentives. Recognizing these differences helps you choose an arrangement that best supports your goals. Now, a quick knowledge check. The question is, which attribute is the strongest indicator that an advisor's incentives align with yours? The options are 1. A written, at all times fiduciary commitment and fee-only compensation. 2. A niche designation focused on a specific affiliation. 3. Unsolicited outreach with compelling fund picks. Or 4. Payment primarily through an AUM percentage and occasional commissions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next, the correct answer is the written, at all times fiduciary commitment combined with fee-only compensation. This pairing reduces conflicts and aligns the advisor's incentives with your best interest. Now for the second check. The question is, over approximately 30 years, what portion of your final portfolio might a 1% AUM fee erode compared with a no-fee scenario, assuming identical gross returns? The options are about 15 to 25%, about 1%, about 50%, or no meaningful impact. You may pause the video now to think about your answer. We will review the answer in the next section. Continuing, the correct answer is about 15 to 25%. The earlier example showed roughly a $247,000 difference on an ending value near $1,325,000, which is close to 19%. Exact figures vary with assumptions, but the magnitude is material. Afterward, remember these non-negotiables. Avoid unsolicited pitches. Prefer and verify recognized credentials. Require fiduciary duty in writing at all times. Model lifetime costs across different fee structures. Finally, promptly audit any rollover to ensure alignment and transparency. Before we conclude, an important note. This content is educational and does not constitute individualized financial, legal, or tax advice. Verify all advisor information on official registries and consult a qualified professional for your circumstances. Past performance does not guarantee future results. Costs, regulations, and standards vary by jurisdiction. In summary, decline unsolicited pitches, verify strong credentials and disclosures, secure a written fiduciary commitment, model lifetime costs carefully, and audit any rollovers promptly. These steps help align advice with your goals and protect long-term outcomes. Finally, if you found this useful, please like the video, share it with someone who is making advisor decisions, and subscribe for more practical money insights. Tell us in the comments which red flag surprised you most and what steps you plan to take next.